Hi friends, I am Francis Mervin Fernandez, a chartered accountant by profession, qualified from the Institute of Chartered Accountants of India. In this short video, we are going to discuss about the first step in the process of accounting, which is journal entry. What is a journal entry? As the name indicates, journal entry means entering a transaction into the journal. And the journal refers to a daily record of such transactions. Every transaction that occurs in a business entity or a concern is recorded into the books of accounts using a journal entry having a debit aspect and a credit aspect. Now, under the traditional approach, the types of accounts were classified into three: personal account, nominal account and real account. And for each type of account, there is a rule which decides which account has to be debited and which account has to be credited. These rules are referred to as the golden rules of accounting. I've done a short video on golden rules of accounting where I have explained what are the different types of accounts, what are the rules applicable to each type of account, and how a journal entry is being framed using these golden rules. The link is mentioned in the description box below. Now let's see how a journal looks like and how the journal entry is passed into the journal. I'll just highlight the rules of accounting so that we can refer to the same here. Personal account, the rule is debit the receiver and credit the giver. For nominal account, debit all expenses and losses, credit all incomes and gains. And for real account, debit what comes in and credit what goes out. A journal consists of 5 columns, namely date, particulars, ledger folio, debit column and credit column. Now let's see what each columns are used for. The first column, date column, is the column where the date of occurrence of the transaction is entered. Second, the particulars column, the accounts that are debited and credited are mentioned in the particulars column along with the narration of the transaction. The third column, ledger folio, is the column where we mention the page number in the ledger where the relevant account can be seen. In the debit column, we mention the amount for which the relevant account is being debited, and in the credit column, we mention the amount for which the relevant account is being credited. Kindly note that a business is treated as a separate entity from the owner. So whenever a transaction is recorded into the journal, it is done in the perspective of the business and not in the purview of the owner of the business. Whenever an entry has to be framed, there are 3 steps in the same. 1. Identify the accounts that are involved in the transaction. 2. Identify the type of account. 3. Apply the respective golden rule. Now let's see few transactions as to how the journal entry is being entered into the journal book. January 1. Jim started business with cash 50,000. The first step is identification of the accounts. Here Jim is one account and cash is another account. Jim is a natural person falling under the personal account category, and cash is a material asset of the company falling under the real account category. So second step, we have identified the type of accounts. Now we have to apply the rule applicable to each account. Personal account, debit the receiver and credit the giver. So Jim is the giver in this transaction, so Jim's account has to be credited, and real account, debit what comes in, credit what goes out. Here cash comes in, so cash has to be debited. So our entry is cash account debtor to Jim's capital account. Since Jim is the owner of the company and he is introducing capital into the business, his account is named as Jim's capital. So now let's see how this is entered in the journal. First column, date column, January 1. Second, particulars column. So in the particulars column, we'll have to enter the accounts that are debited and credited as well, along with the narration of the transaction. So here, cash account debit to Jim's capital. Normally for the credit transaction, we place it a little right to the starting of the first debit line. Ledger folio is normally written during the time of posting these transactions into the ledger, but just for seeing how this is done, we will mention the ledger folio there. Debit column, we will mention the 50,000 because cash is being debited for 50,000. So the 50,000 has to be mentioned in the debit column. And Jim's capital is being credited for 50,000. So that credit amount has to be mentioned in the last column. So this is how the journal entry is framed and passed into the journal book. Now let's take another example. January 2nd, purchased furniture for 20,000. So here identification of accounts, furniture is one account and cash is another account. Furniture and cash are material assets of the company which falls under the real account category. So the rule that applies here is debit what comes in and credit what goes out, which is that of a real account. Furniture comes in and cash goes out. So furniture account debit, cash account credit. Now let's see how it is passed in the journal. January 2nd in the date column, particulars column, furniture account debit to cash account, being furniture purchased for cash 20,000. In the debit amount column, you mention the value of the furniture that has come into the company, and in the credit column, you mention the cash that has gone out, which is both 20,000 each. Now, another example, January 3rd, purchased goods for 15,000 by paying cash. So here, purchase is one account and cash is another account. Purchase is an expense which falls under the nominal account category, and cash is a material asset of the company which falls under the real account. So here there are two rules. One is that of nominal account and one is that of a real account. So for nominal account, debit all expenses and losses, credit all incomes and gains. So purchase has to be debited in this transaction, and for cash, debit what comes in, credit what goes out. Here we have purchased by paying cash, so cash goes out, cash needs to be credited. So your entry is purchase account debit 15,000, cash account credit 15,000. So now let's write it into the journal. January 3rd in the first column, which is for the date, particulars column, purchase account debit to cash, being goods purchased for the value of 15,000 by paying cash. Debit amount column, you mention the value of the purchases, which is 15,000, and in the credit amount column, you mention the value of cash that has gone out for purchasing these goods, which is 15,000 as well. Now next transaction, January 4, sold goods for cash 10,000. Here sales is one account, cash is another account. Sales is an income of the company which falls under the nominal account category, and cash is a material asset falling under the real account category. So for nominal account, debit all expenses and losses, credit all incomes and gains. So sales being an income that has to be credited in the entry, and cash, which is a real account, debit what comes in and credit what goes out. Cash is coming in, so cash has to be debited. So cash account debit 10,000, sales account credit 10,000. That's your entry. So now go to the journal. Now in the date column, January 4, particulars column, cash account debit to sales, being goods sold for cash 10,000. And in the debit amount column, you will have to mention the cash that you have received, which is 10,000. And in the credit amount column, the value of the sales, which is 10,000. Now another transaction, January 8th, paid salaries from bank 8,000. Here salary is one account and bank is another account. Salary is an expense which falls under the nominal account category, and bank is an artificial person falling under the personal account category. So here, how do we frame our entry? For nominal account, debit all expenses and losses, credit all incomes and gains. So salary has to be debited, and for personal account, debit the receiver and credit the giver. So bank is the giver in this transaction, so bank has to be credited. So your entry is salary account debit 8,000, bank account credit 8,000. So how do we write this in the journal? January 8th in the date column, particulars column, salary account debit to bank, and the narration will be being salaries paid via bank. So in the debit account column, you will have to mention the value of the expense, which is the salaries, 8,000, and credit account column, you will have to mention the amount that was paid from the bank, which is 8,000. Now January 9th, another transaction, received commission by bank 5,000. So here, identification of the accounts, commission is one account and bank is another account. Commission falls under the nominal account category and bank is an artificial person falling under the personal account category. So how does the entry get framed here? For nominal account, debit all expenses and losses, credit all incomes and gains. So commission has to be credited in this case, and for personal account, debit the receiver, credit the giver. Bank is the receiver of the commission, so bank is debited in this case. So entry is bank account debit 5,000, commission account credit 5,000. So now going to the journal book, date column January 9, particulars column, bank account debit to commission received. In the narration, being commission received in bank. In the debit amount column, you will have to mention the value that has come into your bank, which is 5,000. And in the credit amount column, you will have to mention the value of the income that you have received as a commission, which is also 5,000. So this is how the transactions are recorded by a journal entry into the journal book. Hope you have understood how an entry is being framed under the traditional approach of classification of accounts and how the entry is being passed into the journal book. Thanks for watching. Bye bye.